A very good afternoon and welcome to HYCM's online trading webinar with myself, Giles Cochran, the Chief Currency Analyst here at HYCM. Hope everybody is doing well. Very warm welcome. Looking forward to taking us through this coming week. So just as folks are coming in to the webinar, I'm just going to run through the normal disclaimer. Remember, the whole purpose of this webinar is educational. So the idea of it is that you can look over my shoulder, someone with a professional trading background, and you can see how I go about understanding the markets, and it helps you in your analysis and how to understand the markets. The idea of these webinars, it's not that it's a signal trading service. So even though we might talk about entries, exits, different instruments for potential trading outlooks, it's not a trading signal service, it's an educational service. Just have to make that clear each time before I start, due to my role with HYCM. So with that done, we'll go to a market recap to start the week. Now, the key thing we need to get our head round to start the week is that the market is balancing some conflicting issues. So the number one issue in the market's mind is now the US election. It's around a week, 10 days away, 3rd of November. Now, the market remembers all the way back to 2016 when there was a surprise President Trump victory. No one saw Trump coming in to win. He won, and there was a large reaction in the market that was the exact opposite of what was anticipated. So a number of market participants would have got their fingers burned. So that means there's a little bit of nervousness approaching this election. There's also reduced volume in the markets due to COVID-19, and so the market is particularly vulnerable to potentially large volatile moves. Remember, one of the strange things about the market is the less orders in the market, it can result in some of the wildest moves. It's because price sort of will jump through almost like vacuum areas to try to find orders when orders are very, very thin in the market. So what that strangely means is that we could see large volatile moves coming into the US elections around November the 3rd, November the 4th. So that's something to be keeping a careful eye out for. That's what the market is thinking about this morning. Now, if we just go and have a look at the charts. If you just have a look at the charts, what we can see is the dollar index finding some bids today. So we can see a little bit of bid into the US dollar, and the US dollar has tended to be bought when the market is in a risk-off mood recently. And that's what we're seeing across the different instruments. Looking at the US futures, you can see that they're down on the session. DAX, Euro Stocks, ASX 200, UK 100 is the exception, and volatility is elevated. So equity markets are showing signs of a risk-off mood. That risk-off mood is also echoed in the yield markets. You can see the bond markets have been rising higher, which is yields just moving lower as of late, and that weakness in the government bond yields has also been flowing through into equity markets. Copper moving lower, Brent, crude complex moving higher. Now, the reason for the crude complex moving lower is falling demand expected into year end with COVID-19 cases rising. We also have Libya coming back to full output, looking at 1 million barrels per day, expected to hit 800,000 barrels today shortly. So that is just pressurizing the oil markets at the moment as well. So all of this has led to some dollar strength, and therefore we're seeing sort of a little bit of pressure in the euro, US dollar, pound, US dollar, Aussie, New Zealand dollar, a little bit more robust than the day that you would otherwise expect. Looking at the currency space, we can see more strength in the high betas, the Aussie and the New Zealand dollar, than you'd otherwise anticipate. Seeing weakness in CAD, which is making sense with both oil down and US dollar being bid. And we're seeing strength in the Japanese yen broadly and a mixed picture in the Swiss franc. So all in all, we're starting the week in a risk-off tone. Now, we don't want to get too carried away with this risk-off tone for the following reasons. One, yes, COVID-19 cases are rising in the US and the UK, but there is also some potentially good vaccine news that's about to come out. So AstraZeneca, there was talk about a London hospital that would potentially have access to an early AstraZeneca vaccine program. We have other major drug companies about to release the results of their vaccine trials this week. And there's a number of companies that have made promising progress in the COVID-19 vaccine area. And so there is a potential that we get some very positive vaccine news coming out in the next couple of weeks. That has the ability to change the risk tone. Now, if we just go back and have a look at equity markets, what we'll notice, I'm just going to pull us back over here, what we notice is that equity markets have been rising higher in anticipation of the US stimulus package. So the US is working through a stimulus package that has still not been agreed. Now, the anticipation and the hope was that the stimulus package would be agreed before the US elections. Now, although in theory that possibility is still here, in reality, it's seen as only political posturing from the major US parties. No one wants to be the person that says, we won't do a US stimulus deal before the US elections, because that makes them look like they're not wanting to help the US companies and the United citizen people ahead of the elections. So no one wants to be perceived to be the baddie and the bad guy. So that's the politics that's playing at the moment in the S&P 500. However, broadly speaking, a stimulus deal is still expected. Whether Biden is ahead or whether Trump is ahead in the polls, both of them are expected to be supportive for US equities. And the reason that's meant to work is that if Biden wins, then he's expected to have higher taxation, yes, but a larger stimulus package, positive stocks. If Trump wins, he's expected to have, yes, less of a stimulus package, but lower taxation, lower regulation, positive for stocks. So the market is seeing both Biden and Trump as potentially positive for stocks. We're seeing a little bit of downside on the risk-off tones at the moment, and on the disappointment that the US stimulus package won't be agreed before the US elections. So that's what's leading to more downside at the moment. So in looking at the market, you would anticipate, potentially more downside to come. But because we're having to balance, could be some positive vaccine news coming, US stimulus package is expected to come, will there be a last-minute breakthrough? US elections are on the horizon. All these variables mean that the market is very, very sensitive to risk and to headlines. So that's why we're in this situation at the moment. So that's just the way of context. Now, going back to the main screen, just be aware that it's US elections that are really driving market expectations. And the stock market is laser focused on US elections. And I want to show you why the polls are very important. If you notice here, the blue line is Democrat Biden's popularity. The red line is Republican Trump's popularity in the polls. You can see that at the moment, Biden is ahead in the polls by nearly 10 basis points, roughly, okay? So you can see Biden is ahead of Trump by roughly just under 10 basis points. Now, if you look at the stock market, you can see that the stock market's high was the same time as the largest difference in Biden and Trump. Remember, President Trump has recently got over coronavirus, and obviously he sort of dipped in his popularity at the time just because people thought, well, is he going to be okay to still fight the US election? So thankfully, there was no harm that came to President Trump, but he bounced back from COVID 19, irrespective of what you think of Trump's policy. You obviously don't wish the man any harm. And so but the point is, this point, when Biden was most ahead of Trump in the polls, was when we saw the highest gain in the S&P 500, which is the gold line. Now, if we just flick back to our charts, that means we want to keep a careful eye on the Biden-Trump presidential lead polls. Okay, so just taking a look at the polls here, we can see that Biden is currently 50-80, and Trump is currently 42-80. Okay, so 8 basis points lead at the moment. Biden's on 50-80, sorry, Trump is on 42-80. So an 8 basis points lead in the polls for Biden. The wider that gap gets, the better it is for stocks, the better it is for Biden. Now, let me explain why. Biden is expected to reverse some of the protectionist policies that President Trump put into play. You know, President Trump, he fought with China, he fought with Europe, he fought with Scotland, he fought with Canada, he fought with Mexico. President Trump's negotiating style is incredibly combative, and he really has made a beeline to fighting China. Now, that combative nature of President Trump has resulted in protectionist policies from the US, which is negative for global growth. And that's been driving some of the dollar higher. So if Biden becomes the new president of the US, that will be reversed. President Biden is not expected to be anywhere near as combative as President Trump. So that's expected to be very good news for the rest of the world, but bad news for the US dollar. So a Biden victory is expected to result in dollar weakness, okay? So you can see that the dollar has been being sold into the US elections, expecting that Biden victory. Now we're seeing a little bit of dollar strength returning here. Now, the closer Trump gets to Biden in the polls, the more chance Trump has of coming in, please excuse me, and the more chance of Trump coming in, then that will result in dollar strength. So keep an eye on these polls. And if Biden gets more and more ahead than Trump, then that should weaken the dollar. And if Biden gets more and more ahead of Trump, that should also be positive for stocks, because Biden is expected to pass a very large stimulus package, larger than President Trump. So that's something, please excuse me, that's something that's expected to be coming on. The other thing to be looking at this week, go back to the main screen, you can see there's quite a few risks. Obviously, Brexit risk. Market's getting quite tired of Brexit risks. We had some positive news on fisheries come out on Friday of last week, but the pound was very muted in its reaction. The basic pattern at the moment is that the pound is being bought in anticipation of an EU-UK trade deal. That's the expectation. The expectation is the pound, but the UK and the EU will find a trade deal. That's why we've been seeing strength in the pound. It's also why there is a euro pound selling bias. Okay, there is a bias for euro pound downside, but just to be aware, the market is starting to get a little bit tired of these headlines, and I think we're getting quite close now. This is just my personal opinion, to having a Brexit deal priced in. Now, unless we see some really good news, some concrete, firm news on either fisheries, state aid, equivalence for financial services, take a screenshot of this if you need to. These are the 3 key issues that are very important. If we get that breakthrough on any of these issues, will be positive news for the pound, but we need to see some real tangible news. Market's starting to get quite tired now of just, general optimism. So getting a little bit tired of these headlines, but nevertheless, the main bias is still towards pound strength. You can see here's the euro pound chart. And as long as we remain just below this trend line here, remain below this trend line, the pound buyers are in charge, and we'd expect more euro pound downside, especially with the EU due to meet this week. We'll look through. In fact, let me just zip forward so you can see on. Let's just call up the sweep. There we go. Now, have a look on Thursday of this week. We have the ECB making their interest rate decision. Now, no change is expected, but this is what we have to be aware of. The ECB have been repeatedly concerned about the strength of the euro. They're also concerned about inflation. Inflation is not really present in the Eurozone. There's rising COVID-19 cases, with France and Italy having record numbers of infections. There's higher likelihood of more serious shutdowns. We also have the German IFO business climate data out, which was not a massive dip, but still was a dip. So the expectations is that the ECB may very well have to talk about adding extra quantitative easing packages to their policy rate decision. What that will mean is potential euro weakness. So that means there is a potential swing opportunity of selling the euro pound into that interest rate decision meeting on Thursday. Now, the dangers with this trade are multiple, because remember, the euro will be pushed around by the dollar. If we see dollar strength, that will push the euro lower. But if we start to see dollar weakness, that will push the euro higher. So just to be aware that the euro-US dollar pair will have a strong impact on the euro pound. But at the moment, that anticipation of a potentially bearish outlook from the ECB on Thursday, because the situation is bearish for them. No inflation, problems with the pandemic program being adopted by all member nations, rising COVID-19 cases, etc., etc., etc. It's hard to see the ECB being positive. With the anticipation sort of an EU-UK Brexit trade deal, then you can see opportunities, potential euro-pound downside. Now, there are risks. Risk to this outlook is if you get some negative Brexit headlines. So the idea that the EU and the UK are going to have a hard deal Brexit, then we expect the euro-pound to rocket higher. Also, we need to keep our eyes open for any potential positive news from the ECB on Thursday as well. Highly unlikely at this stage, but it is a risk to that outlook. So that's the euro pound scenario. Now, going back to the calendar, let's have a look now at the calendar for the week. Going into the week, we have quiet on Monday, quiet on Tuesday. Not a lot here to get excited about. SNB Chairman Jordan speaking. Always worth listening to see what Jordan says. He's obviously always concerned about the strength in the Swiss franc. The Swiss economy is an export economy, which means a strong Swiss franc hurts exporters. The stronger the Swiss franc gets, the more concerned the SNB chair Thomas Jordan will get. Just look out for any news of any intervention in the euro-Swiss franc pair. That's something to look out for Thomas Jordan. Tuesday, quiet day, nothing particularly worth looking at here. We do have the Assistant Governor Bullock speaking. Now, worth just bearing that in mind, because next week, early November, next week, we have the RBA on the 3rd of November making their interest rate decisions. They're expected to cut rates. So anything that Governor Bullock says, if he said something that indicates the Reserve Bank of Australia may not cut rates, expect that to be very positive for the Australian dollar. There's a skew risk here, so look out for that, just in case he says something. Highly unlikely he will, but that's the sort of thing to be aware of. Wednesday, we got inflation data out for Australia. Not a lot of action support expected from this. Remember, the RBA are expected to cut interest rates next week, So that should result in, but that's pretty much priced into the market now. So we're not expected any particular reaction for the Australian dollar. The Australian dollar is likely to be pushed and pulled around the risk tone. Positive risk tone, positive Aussie. Negative risk tone, negative risk tone, negative Aussie. That's the main driver of the Aussie. Bank of Canada. Now, the Canadian dollar has been a very interesting one at the moment, and this is just worth briefly going through. Interest rates are expected to remain unchanged. Economic data for Canada recently has been fairly robust. You can always check back and see here. Data has been pretty good. However, the expectations are that the Bank of Canada is not going to make any changes at all. Remember, you've got the statement and you've got the press conference afterwards. So obviously, if there was a surprise rate cut, expected that would be very negative for the Canadian dollar. It's always worth just being aware of that. Particularly if you're around at the time, look out if you get a surprise rate cut. That will be heavy CAD selling, and you see a lot of CAD yen weakness and US dollar CAD strength. Now, in terms of the Canadian dollar, let me just point something out to you that's worth looking at. Now, in this chart, you have the blue line is WTI crude. You have the red line, US dollar CAD. And you have the gold line, the S&P 500. Now, usually, you have CAD being pushed and pulled around by oil prices. When oil prices rise, US dollar CAD falls. And when oil prices falls, US dollar CAD rises. But you can see here that US dollar CAD has not been correlating with oil prices. So we've had oil prices falling. You expect to see US dollar CAD rising, but it's been falling as well. And you've got oil prices rising, and you've got US dollar CAD rising as well. So the correlation between oil and US dollar CAD has broken down. Now, normally that correlation is about 96%. Normally you can know if oil's going up, US dollar CAD's going down. If oil's going down, US dollar CAD is going up. That relationship has broken down at the moment. However, stocks has been moving much more closely with CAD. You can see, look, US dollar CAD is moving in line with stocks. Stocks are rising up, US dollar CAD going up. Stocks are moving down, US dollar CAD is moving down. Now, a lot of this is to do with the dollar. The dollar's been acting as a safe haven currency. So when the stock markets are falling, the US dollar CAD has been strengthening. When the stock markets are rising, the US dollar CAD has been weakening. Okay, so that's why we're seeing some of this US dollar CAD close relationship. So you just need to see that the Canadian dollar is tracking stocks. Stocks higher, CAD higher. Stocks lower, CAD lower. So just to be aware of that relationship. This is an inverted US dollar CAD scale. So just to be aware of that in the data there. Going back to the rest of the week, we have the don't forget press conference shortly after the monetary policy report. So if there is a shock surprise in the CAD, always check out the press conference. The two events are one event. Don't just set a position and then forget about it. Always look at the press conference. Bank of Japan not expected to make any monetary policy changes at all. No event is expected to that. Main driver of the Japanese yen is risk. Risk off equals yen buying. Risk on, risk selling. Expect that relationship to maintain. So obviously any surprises here will be significant. None are expected. The key event on Thursday is the ECB decision. Don't forget, got the press conference 45 minutes after the main refinancing rate. The expectations here is that the ECB take a more dovish tone. Therefore, I'm expecting euro weakness into the event. So that's why potentially we could see some euro pound selling into Thursday. One to be looking out for. Friday got CAD GDP. And one of the more interesting detail points are the CPI and the flash estimates coming out for Europe to get a sense of how Europe's doing. Also, German GDP and French GDP. So the flash GDP and the preliminary CPI will be important for the euro on Friday, particularly in light of what the ECB have said on Thursday. So do look out for that. And on Saturday, we have manufacturing and services PMI out of China, which the market wants to see that continually growing, continually staying above expansion and moving higher, which keeps optimism going that global growth is getting back on track. So the market wants to keep seeing these figures moving higher, and that shows that the market is expected to bounce back after this COVID-19 hit that we've been having. That and those are the main events. Now, don't forget that during this week, the big event that we need to be looking out for is US election risk. Okay, got US election risk. Don't forget you can reach out to me here at my email, giles.cochran@hycm.com. I have a number of different packages I've put together to help traders understand market dynamics. If you're new to trading and you want to really get your head around how to trade, how to understand market dynamics, just send me a message. I can send you details of that program there. Key event, US election. Election is going to be a big risk. Be very careful not to over leverage or to over expose yourself to any position given the volatility that's expected. A lot of market participants are still sore after 2016. So just to be aware of that as we head in towards the end of the week and the start of next week. November the 3rd, election. November the 4th, we should know who the new US president is. If in the danger of a contested election, the market will become adverse to risk. There is a risk of a contested election, so that's something to be looking out for. Okay. I thank you all for attending. That is the end of the webinar. Don't forget, for HYCM clients, we have another webinar on Wednesday where we drill down into one currency pair. Thank you all very much for attending, and I hope that is helpful and in getting you ready for the week ahead. Thank you all. Thank you, Titus. Thanks, everybody. Take care now. Yeah, thanks, Warren. That is helpful. It does help with getting that relationship on US dollar CAD at the moment. Take care, everyone, now. Goodbye.